Hi, Shaz Nawaz here, and I'm with my partner Joshua, and we're going to be talking to you about regular tax tips in terms of property tax tips. And basically, we're going to be spilling the beans on everything we know. So I've been an accountant for the best part of 20 years. Josh has been an accountant for quite a few years. We've been working with property investors, both as advisors, and I'm a full-time property investor pretty much, alongside being a full-time accountant as well, but that's a story for another day. So in this particular episode, Josh and I are going to share 5 top tips that we think property investors should be thinking about, bearing in mind, so that they maximize their allowances. And on that note, Joshua, how are you?
Yeah, I'm very well indeed. Busy as always. How about yourself?
I'm busy too, obviously with COVID and everything else going on, with the changes in furlough. That's keeping me extremely busy. In fact, I was reading yesterday that the government has given HMRC draconian powers to investigate and look through people who've abused the furlough scheme and the self-employed income support scheme, which in one way is good, obviously, because we don't want people to defraud the system and abuse the system. But at the second time, I don't think any government organization or any organization should have draconian powers to go in carte blanche and do what they like. What's your view on that?
Yeah, I can't see this ending well. And even with the kind of the job retention scheme, it's going to be kind of incredibly difficult for them to come along and really kind of flip the books open for a lot of businesses. And it's going to be fascinating to see what level of detail they go into, what evidence they're looking for to see a lot of these kind of directors that were furloughed. Were they sending emails? Were they marketing? There's going to be a lot of interesting activity that comes from this. I'm not sure about you, but by looking at Facebook, I think a lot of the, I don't want to call it abuse, but a lot of the kind of stuff that's borderline, whether it's kind of abusive, is all around the bounce back loans, people setting up companies like this. And from my interpretation, it doesn't apply to the bounce back loans, does it? It's just the job retention scheme and the self-employed income support scheme.
Yeah, absolutely. So I think the kind of main idea really is to look at the larger employers, because purely from a cost benefit analysis, I assume that if somebody's got 5 employees or 5 or less employees, for example, is it worthwhile HMRC investing all of that money to come to those conclusions as you've already alluded to? Or would they rather pick on or choose or look at those organizations who employ 250 plus employees? I think they're going to start with the bigger ones first and see how it goes. And then they might move on to the smaller ones later. I think that's the angle they're taking. And you're right with the bounce back loans, because people are asking, can I get the money in my limited company and then pay off a personal loan, or can I start a new company and use the money for that? And all types of questions. And I think basically the answer really is, if you're going to repay the loan, then obviously the government will be satisfied that you've met the conditions in terms of repayment. Those who don't repay the loan and all of a sudden get some other bright ideas because they've seen a YouTube video or read an article somewhere, or somebody's told them, that the government don't intend to do anything about it, and you don't have to repay the loan. And I say that because I've heard 1 or 2 people say that, by the way, i.e. they saw a video somewhere or a friend mentioned somewhere. It's not Dave in the pub mentioned nowadays. It's just they heard somewhere on the phone or on a Zoom talk somewhere. So I keep advising them, that's not the case. If you don't repay the loan, of course there's going to be further scrutiny and further review. So make sure that you obviously borrowed responsibly and then you have full intention to repay the loan. Of course, some might not be able to repay the loan because their business, unfortunately, doesn't survive. That's a different case. But taking a loan and then transferring it to repay a separate loan, or repaying a loan where you've given a personal guarantee, for example, or transferring to a different company and then buying some other assets or investments is tricky ground if the loan doesn't get repaid, I think.
Yeah, absolutely. I think as long as the loans get repaid, I think you're going to be all right. But it's where people stop repaying these loans. And I saw a YouTube video of quite a high profile individual who mentioned that it's limited. You've not got a personal guarantee, set up loads of different companies and take advantage of these. They don't need to be repaid, which is wrong. And I think in circumstances like that, it would be good to see HMRC or some other authority really kind of pick a few cases and challenge those to make sure that people weren't falsifying their turnover, even ask them for some kind of solid projection as to how come their company that's been dormant for the past 2 years of a bank account has all of a sudden got £200,000 of expected turnover now that a loan's available. I think it would be good in some of those cases, just for a few questions to be asked to get to the bottom of it.
Yeah, and I think overall, all things being equal, generally speaking, in any sector, in any issue or event, most people are honest, aren't they? So most people have nothing to worry about. You will get the kind of sharks who try and take opportunity, whether it's obviously nowadays with all these scams taking place, people are trying to take advantage. Same with the bounce back loans. I think it's unfortunate that a small minority will end up spoiling it for the majority. But I guess you and I are saying tread with caution. And if you're not sure, seek advice and make sure you're doing everything right during every single step to stay out of trouble, really. Simple as that. So on that note then, what's your first takeaway or tip for property investors, Josh?
Yeah, so this one is all about kind of dividends and especially where you've got kind of a married couple or even business partners, essentially. We'll focus on married couples for now. It's where you've got somebody who's usually a high rate income taxpayer, perhaps a wife's a basic rate taxpayer or might be full-time stay at home. Traditionally, when you've got a company, all dividends have to be paid in proportion to shareholding. So if you've got 50-50 and £10,000 worth of dividends are declared, each shareholder receives 50% of that, £5,000 each. Now, when you've got someone who pays a lot more tax than the other taxpayer, this obviously provides for a bit of extra tax to be paid. But when setting up your company, if you've spoken to a fantastic accountant who's got the structure in place to start with, they might recommend something called alphabet shares. And simply, they allow for different dividends to be paid on different share classes, which the end result is your wife, who's got a lower level of income, might be able to take more dividends than you. So it really allows you to plan a bit more flexibly when it comes to the remuneration you're taking out of your limited company. We could do a whole video through this, but this really was just to make you aware of them, speak to your accountant about them and see how they might apply to you.
So simply what you're saying is husband and wife would have different classes of shares, and let's say the wife owns B shares or 100% of the B shares, you could assign a dividend to the B shares, so the wife gets 100% of that because she can use up her, say, basic rate of tax because the husband's a higher rate taxpayer, which obviously makes good sense and it's good tax planning, isn't it? Yeah,
absolutely. Yeah, that's exactly what it does. They used to use dividend waiver, didn't they? But then they kind of fell out of favour a bit with whether it's a settlement, and we won't bore everyone with that. But essentially, the alphabet shares are a lot more concrete now than relying on dividend waivers.
Yeah, and a dividend waiver, generally speaking, waves a red flag to HMRC, and if you keep doing it every year, it doesn't make any sense. As you've said, have different classes of shares, especially when you're forming a new company, and it gives you that flexibility. And of course, it's not just about flexibility. Then you've got issues of to do with obviously voting rights. You've got issues in terms of what happens on a winding up order. So there are other things that you can restrict, for want of a better expression, by using alphabet shares. So it gives you that flexibility. You might have an employee, for example, where you want to remunerate them for doing certain things, but maybe you don't want to give them voting rights in your company. So again, alphabet shares would be a good mechanism to do that. So that's a very good tip.
Yours.
My one would be capital allowances, because very often I see people buying commercial property, for example, and they don't make all the full inquiries in terms of how much has the vendor or the previous owner claimed in terms of capital allowances, they aren't aware, they don't claim capital allowances, they end up completing on the deal, and the value of the capital allowances is £1, and that just then complicates everything. And of course, this isn't just to do with commercial property. If somebody's in service accommodation, they can also claim capital allowances so long as they meet the tax rules for a service accommodation business. And this has a significant impact on the taxable profits. And you'll obviously know, Joshua, right now, the annual investment allowance, or the amount you can write off in any one given period, is £1 million up until the 31st of December this year, which is huge. And then it's going to go back down to £200,000 unless the current Chancellor changes that, because obviously that particular change was introduced by not the previous Chancellor, but the one before that. So I'm sure the new Chancellor may want to change and put his stamp on how that works. But capital allowances are excellent in terms of reducing your taxable profits. That then opens up another avenue in terms of, if you've got lots of capital allowances, should you use a limited company, or should you, for example, use a limited liability partnership? Because obviously if you use a limited liability partnership, once you've used the capital allowances, all of that money then becomes yours. Whereas, of course, in a limited company, if you use all the capital allowances, let's say you've got no tax to pay in both scenarios, the money's still stuck in the company. If you take it out and there's no loan that you've given to the company as a director, you'll have to pay income tax, bar obviously your personal allowance and your tax-free dividend. So that's another interesting conversation to have, and one that I'm sure you and I will cover on one of the forthcoming videos. So what's your next tip?
So the next one, so tip number 3, is all about a tax efficient way of paying your pocket money. So if you've got children that are over the age of 13 years old, try and get them involved in your business. So their pocket money, it's not pocket money, they have to do work. So any money you pay them has to be commensurate for the work that they've done within the company. So if you've got a teenager, they're great at photography, video editing, social media. Get them involved in your business, and it's it's fully tax deductible as long as it's wholly and exclusively incurred for the business, which means that you can give them pocket money, they can do some work for your business, and you can save tax along the way. What are your thoughts on that one, Shaz?
Well, my thoughts are, my eldest is 13 now, Joshua, so I should give him a job in terms of doing all of my Facebook postings, and then pay him, and then am I allowed to charge him rent, Joshua? Will that be okay?
I think that'd be fair. It's not a tax issue, but I can't see why not.
I bet he'll be pleased with that, won't he? No, but you're right. It's an opportunity. Of course, we've got the settlements legislation for minors, but as you say, if it's commensurate and so on a commercial basis, and the age of over 13. Then it's a good opportunity to get children involved. And I guess, obviously, you and I are tax people and accountants, so we like to talk about the tax advantages, but it's also a fantastic, let's call it an apprenticeship, an opportunity to get one of your children into your business so they can start thinking commercially in terms of how a business works, because no doubt children have a very open mind, and they'll soon be asking questions about how the business works and how different areas in the business work. So it's going to raise their awareness and make them really commercial. I mean, I wish I'd have been part of a business at the age of 13, because by the age of 18, 19, 20, I'd have been really sharp and ahead of the curve. Do you know what I mean? So I think that in itself is a big advantage and a big opportunity. And of course, if anything's tax deductible, you and I like it anyway.
Yeah, absolutely. So a double win on that front. So
that's your one. My next one would be for people, and you and I, of course, Josh, can't give people investment advice, but I would, and I'm sure you would too, say seriously consider making pension contributions. Now, personally, and this is personal to me, by the way, so this isn't advice, but I'm a big fan of having a small self-administered scheme, a SAS, as a pension, which gives you lots of flexibility, and then you can obviously use the funds from that to buy commercial property. You can also buy stocks and shares. You can loan 50% back to one of your companies, or loan to other parties, so you can become an investor. and we all know that in order to become financially free and successful, that the highest pinnacle, so to speak, is to become an investor, because then you've got your hard-earned money which is working for you, and as long as you've got the net relevant earnings in your business, in your trading business, you can then make up to £40,000 contributions every single year. And if you haven't made contribution in the last 3 years, that's carried forward. So in any 1 year, if you haven't made contributions in the last 3 years, you can make £160,000 contribution as long as you've got the profits, and get tax relief. Use those funds then to invest further and grow that capital. So it's a fantastic way. And of course, if there's husband and wife, they've got that opportunity times 2. And it's a brilliant way to use your funds in a tax efficient manner. Plus, of course, to get tax relief on making the transfers into your pension. One thing to note, to link to my earlier tax saving, is obviously if you buy a commercial property through a SAS, then you don't get the capital allowances. So that's something you'd have to balance and consider. And the reason for that is, of course, a SAS does not pay tax. So I would strongly urge people to speak to a financial advisor and at least explore and fully consider the advantages and opportunities of a SAS. So that's in fact, what's your view on that, Josh?
Yeah, even absolutely. So as soon as you mentioned the bit about the profits as well, I thought, well, even if you don't have sufficient profits this year and you do enough to generate a loss, you can get a tax repayment. So contribute to your own pension, add to your net wealth, and get some tax back. People always love it when they hear the news around that one.
Yeah, absolutely. So that's our 4 tips. I think we've given people plenty to chew on there. We would encourage people to, obviously, once you listen to this video, click the button below to subscribe, share with your family, friends, associates, anybody who's either interested in property or is in property. And Josh has a Facebook group called Property Tax Secrets, so please join that group. I have a Facebook group called Trust Property Tax Experts. Join that group. We're always sharing information. Of course, it's not just about sharing information. We're building communities where you get to ask questions, you get to share your expertise, and quite often, and I'm sure Josh will agree, quite often the questions aren't just about tax. They are generally about property and other scenarios. And Josh and I are both more than happy for you to ask those questions in our groups, because you're part of the community. It is your community, and we'd love to see you there.
Yeah, absolutely. Definitely agree with that. So please, everybody, do like, comment, subscribe. Really, just so we know that people have benefited from this. If there's anyone you know who would benefit from this, send them the video, get them to subscribe, because there'll be a lot more of this content, a lot of value that we're doing for you guys. And we just want as many people as possible to see it. But I think that's all for this week's video. Thank you very much for watching, and we look forward to seeing you all next week. Bye.
Thank you very much. Bye-bye.